In this video, we're going to talk about the capital market, which consists of stock and bond market. Without any delay, we will go into the first point.
Firstly, we are going to talk about the characteristics of stock market and bond market. The stock market is where investors go to trade equity securities such as common stocks and derivatives, including options and futures. On the other hand, the bond market is where investors go to trade debt securities, prominently bonds, which may be issued by corporations or governments. Moving on to the risk, stock market has a higher risk. Investors may be exposed to various kinds of risks such as interest rate risk, inflation risk, liquidity risk, operational risk, and market risk, which can affect a company's debt. Whereas bond market's risk is relatively lower compared to stock market. Bond market is more susceptible to inflation risk and interest rate risk. As for the form of returns in stock market, profits earned by the company are paid to the shareholders in the form of dividends. Meanwhile, in bond market, interest payments are made in the form of coupon payments. In stock market, shareholders will gain additional benefits by owning a percentage of the ownership in a company based on the amount of shares he holds. Shareholders also have the right to vote. Meanwhile, in bond market, the bondholders get the preference in terms of repayment and also on liquidation.
For this slide, I will be explaining regarding the roles of stock market and bond market. Okay, for stock market, first role is it is a marketplace for transaction stock securities. Second, it is a marketplace for companies to raise their capital in money. And third one, it is the stock market act as a medium of investment for those who with surplus money. Next, we move to the roles of bond market. Okay, bond market, it generates market signals for efficient investment and financing decisions and the allocation of financial resources. Bond markets also offer households and institutions alternatives to bank deposits.
There are four main participants in stock market, which is stockbroker, listed company, settlement bank, and investor. For the agent brokers, they act as the middleman or agents between the seller and the buyer of stock in the stock market. For listed company, or also known as issuer, these are the company whose shares are traded on the stock exchange. Investors are also called stockholder or shareholder. These are people who own the share of company that are listed on the stock exchange. For the settlement bank perform the function of accepting of deposit of fund for payment or stock bought by an investor or confirm payment of fund when due. Participant in bond market, which is bond issuer, bond underwriter, and bond purchaser. The issuer sell bond or other debt instrument in the bond market to fund the operation of their organization. Bond underwriter, the underwriting segment of the bond market is traditionally made up of investment bank and other financial institutions. Bond purchaser, the final player in the market are those who buy the debt that is being issued in the market.
For the development of stock market, it starts in 1930 when the Singapore Stock Brokers Association was established in Malaysia. But then in 1937, it was re-registered as the Malaysian Stock Brokers Association. Then, in 1964, the Stock Exchange of Malaysia was established. Due to the secession of Singapore from Malaysia in 1965, it became the Stock Exchange of Malaysia and Singapore SAMS. However, due to the currency interchangeability, SAMS is divided into Kuala Lumpur Stock Exchange Berhad and Stock Exchange of Singapore. And in 1986, KLSE Composite Index was launched. In 2004, the stock exchange was renamed to Bursa Malaysia Berhad due to demutualization exercise. And in 2009, KLCI will adopt FTSE Global Index methodology that's now known as the FTSE KLCI. Part the development of bond market, in 1989, the guideline for issuance of principal dealer system was introduced. Then, in 1990, the Code and Conduct and Market Practice for Scriptless Trading in Malaysian Securities Market and the first domestic rating agency was established. In 1996, a fully automated system for issuing and tendering funds was established. And in 1997, the Bond Information and Dissemination System (BIDS) was implemented. Securities Commission became the single regulatory body to supervise and regulate the corporate bond market in Malaysia in 2000.
Next, let's move to the Capitals Market and Service Act CMSA 2007. The Capital Markets and Service Act 2007 CMSA in force on 28 September 2007, passed by Parliament in May 2007, which deals with fundraising activities. A key CMSA measure benefiting capital market intermediaries is the introduction of the single licensing regime. These intermediaries hold a capital market and service license, which effectively reduces administrative and compliance costs and ultimately save time. The licensed activities include the dealing in securities, trading in futures, advising corporate finance, investment advice, and financial planning. The function of the CMSA to ensure a reasonable, practicable, and order manner and fair market in the securities that are traded through its facilities, act in the public interest, and ensure that where the interest that it required to serve under any law relating to corporations conflicts with the interest of the public. Ensure that the members of the stock exchange, also companies and corporations whose securities are listed on the stock exchange with the rules of stock. Lastly, CMSA must provide enough and properly equipped premises for the conduct of its business.
The current issue of the bond market is foreigners set up Malaysian bond at the start of 2021. Despite domestic challenge, Malaysian government bond remain attractive as capital flow into emerging market remain strong given low global interest rate and high market liquidity that boost positive carry trade.
In terms of economic contribution for bond market, firstly, bond market can provide continuous circulation of liquidity. As we know, bond market is made up for deficit units like corporation, federal government, and municipalities that looking for investor or funds. As they receive their fund to finance their project, it will move up the economy. As for example, a fintech that use fund to finance the factory that will produce a new product or new project, and this new project could have a positive impact on the economy as a whole. This is because the new factory will create a new work, and they will appoint a workers, and this worker will receive a salary or paycheck that they could invest or spend. Either way, they are helping in fueling the economy. Secondly, the bond market can combat inflation. Inflation is a reduction of a currency purchasing power and high currency demand. To combat this problem, the Federal Reserve would use monetary policy such as interest on required reserve, overnight reserve repurchasing, and discount rate to influence the interest rate. Thus, rising in interest rate can make the investor more interested in stock because the bond price will fall. Slower economic growth reduce the demand for money since individual and business less likely interested to take out the loans to finance their project. Consequently, lower demand for loans can cause price and interest rate fall, and this falling rate will make the bond more attractive than stocks back again. For stock market, the first point, stock market can influence the consumer spending. A bull market can create a wealth effect to people as they feel more confident because their investment portfolio rise in values. This confidence spill over into increased spending, which can lead to a major purchases such as buying a homes or automobiles. This situation will lead to increase in sales and earning for corporation and subsequently boosting up the country's GDP. The next point is stock market gains. Stock allow the individual investor to own a part of a successful company. Without stock market, only a large private equity investor and financial institution could profit from this free market company. Thus, when an individual investor receives a stock